Lloyds Bank reported its results today, and I'm here with my colleague Chris Thompson to walk through the numbers. Chris, as you know, I'm a simple-minded fellow. Lloyds' profits went down, but it announced that its dividend is going up. How do we square that circle?
Well, Rob, let's start with the profits. Income actually went up at Lloyds, which is great, and operating profits, excluding some charges, are actually doing pretty well.
Charges are a bit of a running story.
Charges are a big running story with this bank. So this is the infamous PPI, or Payment Protection Insurance mis-selling charges.
Right.
Back in 2012, the bank set aside something like a few billion, which it thought would cover it. Now they're paid out about 16 billion. And in the latest results, there's another 4 billion provision for these PPI mis-selling charges.
But before that provision, the bank seems to be doing okay. Talk a little bit about that.
That's right. You see, firstly, their net income is actually going up in contrast to many banks across Europe. And the second thing is their net interest margin, so that's the difference of what they borrow money at to what they lend it on to, is getting better, which again is in stark contrast to the rest of Europe where you've got falling rates.
So in a sense, there's no contradiction here. They did pay a big one-time fine, or what we hope at last is a one-time fine, but the underlying business might be able to support a better dividend.
The underlying business is getting better. That's the message today. However, they've said many times, we hope this will be the last of the PPI mis-selling fines, and yet a new one comes along. It's not so much a case of deja vu now, it's deja vu.
So this isn't the only European bank we've seen that's increasing its dividend. How does Lloyds fit the larger pattern, if it does?
That's right. You've actually got a few big banks now who have reported recently, in particular HSBC, French bank Société Générale, and now Lloyds, who headline pre-tax profits have fallen for one reason or another, but they've actually decided to increase or maintain arguably very generous dividend policies. Now, they want to say to investors, come to us, we're good income stocks, we're doing fine, don't worry about our market, and even more, don't worry about our share price, which, as we can see in the case of Lloyds Banking and HSBC, have fallen quite sharply. Now, you'll also notice Lloyds Banking had a bump today, and HSBC, since it announced the increase in its dividend, has also kind of leveled off. If you can contrast that with Standard Chartered, who also had rubbish results, and they've got no dividend, they've continued sinking.
Yeah, it's very interesting. So is it fair to sum up to say these banks are signaling their confidence with the dividend, but we're not certain that the actual trajectory of profits going forward is going to be sufficient to back up those promises?
This is the key question. Are these generous dividends, are they sustainable? Now, Lloyds, you could say, listen, the underlying business is getting better. Arguably they are. In the case of HSBC, exposed to Asia, ditto Société Générale in a slower Eurozone, are they sustainable? Still big question marks.
Thanks a lot, Chris.